Let's continue our discussions on accounting standards. So we're going to start with one again very practical standard. Okay, again repeatedly tested standard, AS 19, leases. So what is a lease? First thing, a lease is an agreement where the lessor conveys to the lessee. So lessor is the person who gives it on lease and lessee is the person who receives it on lease. Right? Conveys to the lessee the right to use an asset. Remember, we are only transferring the right to use an asset and we are not giving the ownership. We are not transferring the ownership for an agreed period in return for a payment or for a series of periodic payments. So it can be for a lump sum payment or periodic payments. So the point here is it is only for the right to use of the asset. Now, three places where this standard is not going to be applicable: natural resources lease, manuscripts, videos, copyrights, patents. So all this is not going to be applicable. Land lease. Property lease is applicable, which means land plus building. Property lease will be applicable. Okay, where I'm taking the building on lease. That is applicable. But land exclusively, lease is not going to be applicable.
Even agricultural land.
Yes, yes. Agricultural land, then land given by government on 99-year lease, all that will not be applicable under AS 19. Okay. So this standard is predominantly going to speak about accounting. How we need to account for lease transactions in the books of both lessor and lessee. Right? So let's start first by understanding the two types of lease. What are the two types of lease? Finance lease, operating lease. Okay. Friends, the focus first is going to be on finance lease. I will come to operating lease separately. What is a finance lease? A lease is a transaction where there is no ownership transfer, but there can be some leases where the property in the goods is transferred without transferring the title, which means the risk and rewards are beneficially transferred, but the legal ownership alone is not transferred. So such leases are generally called as finance lease. A lease is classified as a finance lease if it transfers substantially all risk and rewards incidental to ownership to the lessee, whether or not title is transferred. So it does not matter about title, it is only about the risk and rewards that are substantially being transferred. Right? There are a few scenarios which we can test to identify whether a lease is a finance lease or an operating lease. So if certain conditions are present, if any of those conditions are present, then we can treat it as a finance lease. What are those conditions? First, if the ownership of the asset is transferred at the end of the lease term, which means if the lessee can purchase the asset, okay, after the lease period mandatorily. Or second, the lessee has the option to purchase at a value which is very, very less than the fair value. So if suppose the residual value or the fair value at the end of the lease period is 2 lakhs, but the option to purchase is given just for say 10,000 rupees or 15,000 rupees, very minimal value. So if the lessee has the option to buy the goods or buy the property, okay, at the end of the lease period, which is at a value which is very much lesser than the fair value, then it is again an indication of finance lease because beneficially you are transferring the ownership already. Third, the lease term covers major part of the economic life. So if the lease period is 3 years for an asset which is useful only for 4 years, so most of the portion of the useful life of the asset is getting utilized in the lease period. Fourth, if the value of the asset is substantially covered by present value of minimum lease payments. Friends, please highlight this point and keep. This has been a recently tested question. As on the date of lease, we will calculate the present value of lease payments, and if that lease payment significantly covers or majorly covers the fair value of the asset. If not more, if it covers a significant portion, say 90 to 95% of the fair value of the asset, then it is again termed as a finance lease because effectively the cost is getting recovered. So that is the reason. Last point, the asset leased is of a specialized nature where if any other person has to use it, they have to incur major modifications. Okay, so if any of these conditions are applicable, then the lease can be termed as a finance lease. Okay, even if one condition applies, it becomes a finance lease in nature. Right? So these are the conditions for finance lease, and they might test you giving certain scenarios and asking whether it amounts to an operating lease or finance lease. Okay. Coming to the accounting part. Book value of, so accounting part we are going to see from the books of the lessee and lessor. So we are going to see what will be the book value or recognized value in the lessee's book and what will happen in the lessor's book separately. So I have given you the overall summary of the transactions. Okay. But parallelly, let us also understand the journal entries so that it is easy for us to pass journal entries in the exam if asked. First, recognition. Let's go in the books of the lessee first. So lessee is the person who has taken the asset on lease. Now, the lessee has the right to record the asset in his books, which means if it is a finance lease, the lessee will record the asset in his books and lessor will de-recognize it. So the asset now will be inside the books of the lessee. Okay. So let's quickly also note down the journal entries. Has everyone got the handouts? Yeah. Three. Three copies. Three copies. Okay. So first entry, books of lessee. The asset is recognized in the books. So asset account debit at the time of taking the lease. 2. Lessor account. Asset account debit to lessor account. Okay. The asset value will be recognized at the lower of fair value or present value of minimum lease payments. Lower of fair value or present value of minimum lease payments. Yeah. So to lessor XYZ, whoever is the person. Now the lessor's amount will be actual amount payable or total of installments payable. Okay. Or in other words, minimum lease payments. Minimum lease payments. What is this minimum lease payments? We will come to it. Okay. So basically, if you are agreeing to pay 1 lakh rupees at for 5 years, 5 into 1 lakh rupees is the amount that you will take it in the credit side in the lessor account. Okay. So here, the entry is not yet complete. Before I complete the journal entry, here we are discussing about minimum lease payment. So let us first understand that, then we will complete the journal entry. Minimum lease payments is nothing but the amount in the lessee's books, the amount that the lessee will be paying to the lessor. So as a formula, you can remember for lessee, minimum lease payments is lease rentals. Whatever is your periodic rentals, 1 lakh into 5 years, 1 lakh, 2 lakhs into 5 years, whatever is the periodic rentals, plus guaranteed residual value by the lessee. What is guaranteed residual value? At the end of the useful life, if the lessee says, I will pay you so and so rupees, then that is guaranteed residual value by the lessee. If a third person says, I will pay the lessor some residual value, then that is not guaranteed by the lessee. Okay, that is guaranteed by the third party, not guaranteed by the lessee. So for minimum lease payments in lessee's books, two things: lease rentals plus guaranteed residual value. Okay, so minimum lease payments is equal to lease rental plus guaranteed residual value of lessee. Now I am using another term in the debit side, which is present value of minimum lease payment. So what is present value? Present value is nothing but the discounted value of minimum lease payments. So discounted value of minimum lease payments. Okay. When we say discount, we always tag it with a percentage. How that percentage has to be taken? So discount percentage is equal to IRR of the lessor or lessee? IRR of the lessee, or IRR which is commonly which is calculated based on the scenario. Ideally, generally IRR will be taken from the lessor's perspective practically. Okay, IRR will be taken from the lessor's perspective and lessee will use his internal discounting. Okay, so if IRR is available in the question, use IRR. So IRR or cost of incremental borrowings. Cost of incremental borrowings. If IRR is given in the question, you can use it. If IRR is not available, if there is a cost of borrowing, incremental borrowing is additional borrowing given in the question, use it. Right? If the question does not give us any rate of interest, then we can calculate IRR. That formula we will come to it separately. Okay, but most of the cases you will be having IRR given in the question. Now, there will be a difference between the credit and the debit amounts, where the debit amount considers only the present value or fair value, whichever is less. Whereas the credit side, we are considering the entire value, okay, without discounting factor. The difference is what is the interest cost or the finance charges for the lease. So your journal entry is going to be asset account debit, finance charges account debit. Finance charges account debit. Okay, to lessor. Right? So the first entry itself, please remember, it is not asset to lessor, it is asset account debit, finance charges account debit to lessor. Asset is recognized at fair value or present value of minimum lease payments. Lessor is going to be the actual minimum lease payments and the difference is taken to finance charges. What is minimum lease payments? Lease rental plus guaranteed residual value of the lessee. Okay. Now, next entry. Okay. At the time of installment payment. So when the installment is actually paid, lessor account debit to cash or bank account. Whatever is the installment that is paid. Lessor account debit to cash or bank account. Next. Transfer of finance charges. I need to transfer the finance charges to expenses. Can I take the entire finance charges to expenses? No. finance charges has to be taken proportionately over the period of the lease. Okay. So what will be the journal entry? P&L account debit to finance charges in proportion. P&L account debit to finance charges in whatever proportion available. So first entry is for recognizing the asset. Second entry, payment of installment. Third entry, P&L to finance charges, transfer of finance charges. And the last point, last entry is for depreciation because the asset is recognized in the books of the lessee. What is the entry for depreciation? The entry is going to be the usual entry, depreciation account debit to asset account or to provision for depreciation. We'll generally take it as to asset account. And P&L account debit to depreciation. Okay. So four points in terms of entries to remember. What are the entry points? Recognition of the asset, installment payable, interest transfer and depreciation. Whatever is the amount of interest that is available balance will be shown in the balance sheet. Okay. So in your balance sheet, lessor will appear in the credit, in the liability side. The amount shown as finance charges will be subtracted from that lessor in the liability side. So please make a note. If asked for balance sheet presentation, in balance sheet, liability side, lessor balance less finance charges unamortized. Whatever is not taken to P&L account will be subtracted from the lessor balance and the net balance will appear in the liability side. And in the asset side, the asset will be shown minus depreciation. Asset is shown minus depreciation. Right? So this is about your lessee's books. Let's quickly recap again. Record the asset at the lower of cost of fair value or present value of minimum lease payments. What is minimum lease payments? Lease rental plus guaranteed residual value by the lessee. What is the rate of interest? IRR or incremental borrowings. Now suppose if it is not given, we need to use the IRR formula which we will come when we do the lessor's books. Okay. How to recognize the expenses in the books? Lease payments is recorded along with finance charges apportioned over the life of the lease. So finance charges is apportioned. What is the total of finance charges? Total minimum lease payments minus cost of the asset. That difference is what is called as finance charges. And depreciation is claimed for the lessee's books. So this is about books of the lessee. Is that clear? Okay. Now coming to the books of lessor. Now in the books of lessor, we are not going to have the asset. So we are going to de-recognize the asset or remove the asset from the books. Generally that asset will be any item of machinery or any item of stock for the lessor. So now let's see how the journal entries are going to flow for the books of the lessor. First, at the time of giving the asset on lease, lessee account debit to, what is the amount that is recognized? If it is treated as an asset, or if it is treated as a stock, then it will come as sales. Okay, whatever is the transaction. 2, unearned finance income. If it is charges in the lessee's book, here it is going to be unearned finance income. Okay. Now again comes to the value. What happened? Okay. What will be the value? The value is going to be, the asset or sale will be recorded at net investment in lease. For the lessee, it is going to be taken as gross investment in lease. And the difference is going to be your unearned finance income. Okay. So gross investment, net investment. These are the two terms that is going to be relevant for the books of lessor. Now what is the formula for gross and net investment? Gross investment is equal to minimum lease payments plus unguaranteed residual value. Is there in the notes, but let me also write it again. Gross investment in lease is equal to minimum lease payments plus unguaranteed residual value. What is the formula for minimum lease payments? Lease rentals plus guaranteed residual value of lessee. Since we are in the lessor's book, we should also include guaranteed residual value of third party. So minimum lease payments are different for lessee and lessor. Please remember it. Whichever book you are using, accordingly your minimum lease payment value will change. So minimum lease payments is lease rentals plus guaranteed residual value of lessee plus guaranteed residual value of third party. And gross investment is minimum lease payments plus unguaranteed residual value. Okay. Next comes net investment in lease. It is generally the fair value of the asset. Okay. Mostly it will be equal to the fair value of the asset. Suppose if it is not available, how to calculate? It is nothing but present value of minimum lease payments plus present value of unguaranteed residual value. So basically present value of gross investment. Okay. Yes. Net investment in lease. Okay. Net investment in lease is nothing but either the fair value of the asset. Mostly it will be equal to the fair value of the asset. If fair value is not available or you cannot arrive at it, then it is present value of minimum lease payments plus present value of unguaranteed residual value. So what is this basically? Gross investment in lease oda present value. Discounted value of gross investment. In simple terms, if we have to put it. That is discounted value of gross investment. Okay. So again, when we say discounting, we need to know what is the rate of discount. The discount rate will be generally the IRR. Here we don't have any incremental borrowings because lessor is the seller or the person who is giving the property. He is not borrowing the property. So here we only go by IRR. Okay. Now suppose IRR is not available. If you want to calculate IRR, what formula should you use? Or suppose installments are not available. I want to calculate the installments. What formula should be used? The formula is very simple. Net investment in lease is equal to the fair value of the asset. And it is equal to the present value of minimum lease payments plus present value of unguaranteed residual value. So we are going to use this equation. Fair value of the asset is equal to present value of minimum lease payments plus present value of unguaranteed residual value. Because if IRR is not available, fair value will be given. Edha one question la available. So accordingly, you can see whichever is absent, you can calculate. Right? So please make a note of this equation. This is your equation for IRR. Whether lessee's books or lessor book, if you want to calculate IRR, if you want to calculate installments, this is your equation. Okay? Yes, Radha, fair value of investment in lease is generally the net investment in lease. Okay? So what is the major point to be remembered here? Minimum lease payments for lessee is only lease rental plus guaranteed residual value of lessee. Whereas for lessor, it is MLP plus guaranteed residual value of lessee plus guaranteed residual value of third party. Okay, this is the distinction. Other points, unguaranteed residual value will be included in lessor's books, whereas in lessee's books, it will not be included. Okay, so the first journal entry we have already seen. In the lessor's book, lessee to asset or to sales to unearned finance income. And what will be the next entry point? The next point is when you are receiving the installment. Bank account debit. Installment received. Bank account debit to lessee account. Similarly, I need to transfer the income to the P&L account. So, transfer of income, which is unearned finance income account debit to P&L account. Unearned finance income account debit to P&L account. Unearned finance income is nothing but the difference between gross investment in lease and net investment in lease. Basically, the amount that you are gaining over and above the fair value of the asset. Okay, so unearned finance income is nothing but gross investment minus net investment in lease. Right? Now, in the lessor's book, depreciation, will it be applicable? No, the lessor cannot claim depreciation on the asset. Okay, so lessor's books, remember the points. There is a difference in MLP calculation. The unearned finance income is nothing but gross investment in lease minus net investment in lease. and this income will be apportioned proportionately over the years. So it will be taken to P&L account proportionately. Right? Now coming to the balance sheet of the lessor. In the asset side, yes, I think someone was asking online. Yes, whatever is the principal or the cash amount that you will ideally recover as the fair value of the asset, over and above, if you are recovering something, then that is what is your interest component or finance income. Right. So asset side, what will be shown in the asset side? The lessee's balance, lessee account will be shown as the whatever is the balance of the lessee account minus unearned finance income not amortized. So whatever is not charged in P&L account, the remaining amount will be subtracted. So lessee's balance minus unearned finance income not amortized. Right? So this is about lessor's book of finance lease. Quick recap. Asset is derecognized or removed from the books. Receivable amount is recognized as net investment in lease. What is net investment? Gross investment minus unearned finance income. This is what appears in your balance sheet. Gross investment minus unearned finance income, or lessee account minus unearned finance income. MLP, lease rentals plus guaranteed residual value of lessee plus guaranteed residual value of third party. Gross investment is MLP plus unguaranteed residual value. We also have the IRR formula. Present value of MLP plus present value of unguaranteed residual value is equal to the fair value of the asset. What is the unearned finance income? Unearned finance income is to be taken proportionately over the life of the lease. So total unearned finance income is nothing but your gross investment minus net investment. Depreciation not claimed. Simple. Okay, these are the rules you will remember for finance lease. Quickly take 2 minutes to run through. We will do a question on finance lease and then go to operating lease. Okay. So a simple example to start with. Fair value of the asset is 15 lakhs. Lease rental is 5 lakhs for 3 years. So period of the lease is going to be for 3 years. Guaranteed residual value of the lessee is 20,000. Unguaranteed residual value 50,000. Calculate the IRR. Okay. So how to calculate IRR? What is the equation that we are going to use for calculation of IRR? Fair value of asset equals present value of minimum lease payments plus present value of unguaranteed residual value. Now minimum lease payments, should it be from the books of lessor or lessee? For calculation of present IRR or installments, whatever it is, minimum lease payments is always from the books of lessor. Please make a note, it is always from the books of lessor. Okay. So now 15 lakhs fair value is equal to present value of 5 lakhs for 3 years, correct? Plus 20,000. Is the 20,000 guaranteed residual value at the end of the 3 year, or is it for all the 3 years? It is at the end of the 3rd year. So 20,000 rupees at year 3 plus unguaranteed residual value. Because we are in the books of lessor, we need to take the unguaranteed residual value also, plus 50,000, present value of 50,000 at the end of 3 years, at year 3. So how do we calculate this? Okay, the normal rule of IRR calculation that you would have learnt in FM, same way we are going to do. Let's draw a table for 3 years. Year, amount, discount rate, discounted value. Okay, so year 1, what is the amount that I am going to receive in year 1? 5 lakhs. Year 2 is again 5 lakhs. Year 3 is 5 lakhs plus guaranteed 20,000 plus unguaranteed 50,000. So 5 lakh 70,000. Now if discount rate was available, we could have directly applied. We don't know. So let us assume an IRR. Assume a rate, start at 10%. Always easy to start at 10%. So assume it start at 10%. So you will have 1 divided by 1.10 the whole power 1. Okay, FM repeats itself. You have to calculate. Please do the calculation. 0.909. For year 2, 1 by 1.10 the whole power 2. 0.826. 1 divided by 1.10 the whole power 3. 0.751. So now your discounted values are going to be 4,54,500. 5 lakhs into 0.826. 4 lakh 13. 13,000. 428. Okay. Now listen here carefully. Total 12 lakh 95,570. Now this is where you have to understand the fair value of the asset is 15 lakhs. But assuming an IRR of 10%, I am only getting a net investment amounting to 12,95,000, which means your IRR is not 10 lakh, because if IRR is 10%, fair value should be equal to this present value, right? So now I have to shift to the next rate. Should I increase the rate or decrease the rate? We need to decrease the rate because here the present value is less than the fair value. So if I want to increase the present value, I need to decrease the discount rate. Remember this rule? You can write it and keep. If your present value has to decrease, then you need to increase the rate. And vice versa. Okay? So you can assume, say, probably 8%, 7% or 5%. Simple calculation, let's assume 5%. Discount rate at 5%. So what are the rates? 0.952, 907, 907, 0.864 or 863 discounted value. $476,000, 4,53,500, 4,92,480. Which means, poor thing, your IRR is not even 5%. 14 lakh? 21,887. So is your fair value still equal to the present value? No. So now again, to equate it, what can we do? We have to further decrease the discount rate. So what we are going to do here, we are going to take 3%. Please calculate it 3% and give me the final answer. You can calculate it independently. Calculation needs calculator and pen and not mouths. Okay. Decrease further. Go to 1% flat. So I have given numbers in for classroom example. So definitely you might get lesser IRR. Doesn't matter. Okay. So I'm summarizing whatever we discussed here. Please listen carefully. Present value at 10%, you got it as 12,95,570. When we calculated present value at 5%, we got 14,21,887. When you are calculating present value at 3%, what was the value that you got? Please calculate and give me your answer. 1478, 331. Friends online, are you with me here? Have you calculated it? Okay. Again, it is still not covering your 15 lakhs. So let us decrease it further. Present value at 1%. Okay. So I am getting an answer of 1538, 433. I'll wait till you complete the answer. Please complete. Okay. IRR can never go below 1. Minimum 1% return kuda illana adukku neenga cash sale pannirunga naturally. See, this is a number that I did it in the class for understanding, so numbers will be different. But exams, you will generally get IRR somewhere between 10 to 15, something like that. Okay? So now, we need to consider, okay, I hope you have got present value at 1% as 1538. So for calculation of IRR, we need to calculate the interpolation or the relation between this 1% and 3%. Basically, one value above the fair value and one value below the fair value. Okay. So IRR is equal to 1% plus 38,433. The usual IRR calculation, friends. So what is the answer that you are getting? Okay. Okay, let me explain the calculation, formula calculation. If you have not got it here, 1% is the lowest value of discount rate. Listen carefully here. 1% is the lowest value of discount rate plus difference between fair value and present value at 1%, which is 38,433, divided by difference between fair value and present value of 1% and 3% together into the difference between the two rates, which is 2. 3 minus 1, which is 2. Okay. So which will give you answer of 2.27% or 2.278%. Same IRR calculation that you learn in your cash discounting techniques in your financial management. No change. Same formula. Just that the formula that we use here is based on fair value. Okay. This has been one of your questions in the latest amended questions in your materials also. So might have a larger probability of being tested in the examinations. Okay. Now, I hope this is clear, friends. 2.27% calculation of IRR. Any doubts in calculation of IRR? Okay. For the same question, we are going to calculate the finance charges in the books of lessee. Let's go ahead and calculate finance charges in the books of lessee. Okay. Now, how do we calculate the finance charges in the books of lessee? What is the formula for finance charges? Minimum lease payments of lessee minus cost of the asset. Minus cost of the asset. Okay. So what is the minimum lease payments of the lessee? What is the minimum lease payments in this case? Lease rentals plus guaranteed residual value of the lessee. So which is 5 lakhs into 3 plus guaranteed residual value of lessee is 20,000 minus cost of the asset. Now here cost of the asset can be taken as the present value of minimum lease payments or fair value, whichever is less. Okay, so here since we have only calculated the interest rate, our present value and fair value will be equal. Okay, so we can directly take fair value into consideration. But in the exam, we need to calculate the present value separately, which we will do it in a separate question again. Okay, so in this type of question where you are calculating the IRR, your present value and fair value will be equal. You can directly take cost of the asset is equal to fair value and close. So what is your finance charges? 20,000. Okay? Yes? Yes, ma'am. Tell me. Done? You're clear? Okay. Example 2. If the cost of the asset is higher than the present value, actual cost, then the lessor will not give it at lease only, practically. But if the fair value is higher, okay, then in that case, then the evaluation comes whether it is an operating lease or finance lease. One of the indicators of finance lease is that the fair value should not be very much higher than the present value of lease payments, or present value significantly covers the fair value, in other words. Example 2. Sorry, fair value of asset 10 lakhs. Lease rentals 2 lakhs, sorry, 3 lakhs for 5 years. Guaranteed residual value of lessee 10,000. Total residual value of asset 25,000. Assume a rate of interest or IRR at 10. Let's assume 10% I'll work. Calculate finance charges for each year in the books of lessee. Okay. So in the books of lessee, what is the rule for finance charges? Very good. Finance charges is equal to minimum lease payments minus cost of the asset. Now, what is minimum lease payments here from the lessee's perspective? Lease rentals 3 lakh for 5 years. Plus guaranteed residual value of lessee 10,000. Now, the question says total residual value and guaranteed residual value is 10,000. What is the difference? The difference is called as unguaranteed residual value, which is not relevant in the lessee's books. It will only go to the lessor's books. Okay? minus cost of the asset. Here, since IRR is available, we need to calculate the present value of the minimum lease payments. So calculate present value of minimum lease payments is equal to. Okay. You can also take the annuity factor for 5 years at 10%. So annuity factor, you can directly calculate it. In some of your exams, they give you the factors. So if they give, well and good. If they don't give, at least take 3 decimal calculation. Don't take 2 decimals and work. Take 3 or 4. So what is the annuity factor for? The annuity factor for 10% at 5 years is 3.791. Okay. So 3.791 is the annuity factor at 10% for 5 years. I hope everyone is clear with this calculation of annuity factor. And for the 5th year, what is the present value or discounting factor for 5th year? 0.621. Okay. For simplicity's sake, let me write the discounting factors. Can you tell me the factors year on year? 10%, 0.909. Okay, 0.826. 0.751. 683. 621. So your annuity factor is nothing but the total of the discounting factors for 5 years. And last year discounting factor will be considered for the guaranteed residual value of 10,000. So plus 3 lakhs into 3.791 plus 10,000 into 0.621. Are you getting 11,43,510? Yeah, 11,43,510, which is the present value of minimum lease payments for the question. Fair value is given as 10 lakhs. Therefore, the cost will be lesser of the two, which is 10 lakhs. So, cost is going to be taken as 10 lakhs. Which gives you your total finance charges as 15 lakh minus, okay, 5 lakh 10,000. This summarizes your total finance charges. Now you can also be asked to calculate the finance charges for each year. Let's write the table. It is a table like how you do it for your hire purchase calculation, where we calculate the interest rate proportionately. So same way we are going to do year, opening value, interest, installment, principal and closing value. So year 1, you start with the opening value, which is the cost that is recognized. What is the cost recognized in this case? It is not 11 lakh 43, it is only 10 lakhs. So we start with 10 lakhs. Okay. Interest is going to be at 10%. Okay, because that is your IRR. Interest is going to be at 10% for 1 year, which is 10,000, right? 1 lakh, sorry, 10 lakhs into, sorry, 10 lakh into 10%, 1 lakh, right? Okay, 1 lakh. Interest is going to be calculated on the opening value at 10% for 1 year. First year, what is the installment that we are paying? We are paying a lease installment of 3 lakhs. And therefore, the principal is going to be for 3 lakhs is the installment paid, of which 1 lakh rupees is interest, and therefore principal is 2 lakhs. And hence, closing value is nothing but the opening value minus principal. Okay? Which is 10 lakhs minus 2 lakhs, 8 lakhs. Now all starting trouble rectified. Second year, 8 lakhs is your opening value. Interest at 10%. Okay, interest at 10% is 80,000. Installment is again 3 lakhs. Therefore, principal paid is going to be 2 lakh 20,000, which reduces your closing value to 8 lakh minus 2 lakh 20,000, 5 lakh 80,000. Similarly, we will go ahead and compute it for the remaining 3 years. This table can be asked for a 5-mark question. Go ahead and compute. $71,800, right? 71,800. Now, for the 5th year, okay, for each year we have done the calculation. 3rd year, I am continuing. 5,80,000, 58,000 is your interest, giving you an installment of 3 lakhs and principal of 2,42,000. Closing balance is nothing but opening balance minus principal, which is 3,38,000. Now 4th year, 3,38,000, 33,800 is your interest, 3 lakh is the installment, principal becomes 2,66,200, and closing value is 338 minus 266,200, which is 71,800. Now 71,800 is the opening value. Interest is going to be, That is not how we take the interest. Remember, in the last year, your closing value has to become 0. So what is the total installment? Principal of 3 lakhs plus, listen carefully, principal of 3 lakhs plus guaranteed residual value of 10,000. So 3 lakh 10,000 is your installment. Okay, of which your principal outstanding is 71,800, which means I should have get 71,800 here. Closing value has to become 0. So your differential figure will be taken to the interest column in the last year, which will amount to 2,38,200. Okay, so this can be tested in a 5 mark where you will be asked to calculate for the 5 given period. You need to calculate your finance charges for each year. Last year alone, remember, it should be a balancing figure. Okay, please take down. Is this clear? Friends online, I hope I'm clear. Any doubts you can ask now. Okay. So now we are continuing. This is about your finance lease. Yes, Sanjay, the last lease is also inclusive of profit. That is why you see the difference. It's not profit as such. It is actually the additional finance charges that you are paying. Profit will come only in the lessor book, not in the lessee's book. Right. Okay, coming to operating lease. What is an operating lease? That which is not a finance lease shall be categorized as an operating lease. So, for operating lease, the rule is very simple. In the lessee's book, no asset will be taken. Lessor's book itself, the asset will remain. Whatever payment the lessee is going to make will be treated as expenses. And in the lessor book, that payment or that amount of installment received will be treated as income. Proportionately over the lease period. Income has to be taken proportionately over the lease period in the books of the lessor. For lessee, actual payment is actual expenses. Whereas for lessor, proportionate payment will be taken for income recognition. Okay. Lease rentals are recognized as revenue in the books of lessor proportionately over the lease period. Right? So operating lease doesn't have much classification as such, so or much working out as such. So the point that we have to remember is proportionate income recognition for lessor. That's all. Moving on to the third type of transactions that can be recognized under lease, sale and lease back. So what is this concept of sale and lease back? Where the asset is sold by the lessor and immediately leased back, which means I sell it and immediately take it up for utilization or purpose. So the ownership is transferred, but the possession is retained. Okay. So in this case, there are two categorization. If the sale and lease back, so the lease back is where we are concerned. If the lease back results in a finance lease, the profit or loss on sale is deferred and amortized over the lease period in proportion to the depreciation. So if it results in a finance lease, the profit on loss will be taken proportionately in accordance with the depreciation. if the lease back is an operating lease. What is an operating lease? Where the ownership is transferred, but when it comes to an operating lease, there is no beneficial ownership. Okay, so in this case, there are two rules that you have to remember. Rule number 1, book value versus fair value. Book value versus fair value. So what is the difference to be taken? Book value and fair value we need to compare, and whether there is a profit or loss, it should be recognized immediately in the books. Okay, if book value is less or more, doesn't matter. Profit or loss are immediately recognized. Rule number 1. Rule number 2, fair value and sales proceeds. So first is the carrying cost or book value and fair value. Next, fair value and sales proceeds. So now, if the sale value is greater than fair value, it is a profit. That profit is deferred and amortized over the lease period. Whereas if sale value is less than the fair value, then it is a loss. Recognize it immediately, provided or unless there is a future lease installment compensation for the loss. Unless it is compensated by future installments, it needs to be recognized immediately. So here we can remember it as two rules. First rule comparison is book value, fair value. Second rule comparison is fair value, sale value. So two separate rules, we can remember it for operating lease back transactions. Clear? Okay. A quick recap. Take 2 minutes time to recap the standard, and we start with your past asked questions. Any doubts? You can ask it now. Shall we? Question number 11. Classify the following into either operating or finance lease. First, if the, Navya is asking if the problem is silent. The problem will never be silent. They will definitely give you in whose books you need to calculate. Don't worry about it. Okay. First, present value of minimum lease payments is equal to X. Fair value of the asset is equal to Y, and X is equal to Y, which means present value of minimum lease payment is equal to the fair value of the asset. In this case, what will be the classification? It will be taken as please look at the indicators for finance lease. One of the indicators of finance lease is that the fair value of the asset will be compensated significantly by the present value of lease payments. So either it will be very closely near or it will be equal. So when the present value of minimum lease payments is equal to, okay, or is significantly equal to the fair value of the asset, then it will be classified as a finance lease. Okay. Second, economic life of the asset is 7 years. Lease term is 6.5 years, but asset is not acquired at the end of lease term. Doesn't matter. One of the conditions is if the economic life of the asset is covered significantly by the lease period, the lease will be classified as a finance lease. So even if any one indicator is satisfied, it will be classified under finance lease. Third, economic life of the asset is 6 years. Lease term is only 2 years. But the asset is of special nature and procured only for the lessee. So when the asset is of specific nature, again it gets classified as finance lease. Okay, please make a note of the answers. The solutions will be given to you. Don't worry about it. Just make a note of the answers along with the hints. Clear? Question number 12. Viral Limited sold a machinery having WDV of 40 lakhs. So when it is WDV, what is this? Book value of 40 lakhs to Saral Limited for 50 lakhs. The same machinery was leased back, okay, by Saral Limited to Viral Limited. The lease back is in the nature of operating lease. So what are the two rules for operating lease? Book value and fair value and sales proceeds. Now you are required to explain the treatment in the given case. First case, fair value is 45 lakhs, sale price is 39 lakhs. So let's go to the answers and see. First, rule number 1. Let's go rule by rule. Book value and fair value. So what is the comparison of book value and fair value? 40 lakhs is the book value. Fair value is 45 lakhs. So 5 lakhs is a loss or gain. Book value is increasing. Therefore, it is a gain. Fair value is 45. La? Fair value is 45. Yeah. Therefore, when the book value is less and fair value is more, it is a gain. So, first rule, under rule 1, gain of 5 lakhs recognized immediately. We have not completed. Okay. Now, rule 2, fair value and sale price. Fair value is 45 lakhs. Selling price is 39 lakhs. What is the difference? It is a loss of 6 lakhs. So, loss of 6 lakhs recognized immediately. So, here if you see gain of 5 lakhs, loss of 6 lakhs. So, we can write it as net loss of 1 lakh to be recognized in the books. So, here we can just write it as net loss of 1 lakh. Next, book value and fair value again. Book value is 40 lakhs, fair value is 40 lakhs. So, no change, no impact. Rule 1, no impact. Rule 2, fair value and selling price. 40 lakhs is the fair value, selling price is 49 lakhs. 9 lakhs profit, under rule 2, it is deferred and amortized over the lease period. Deferred and amortized over the lease period. So, profit of 9 lakhs deferred over the lease period. Third answer. Fair value is 46 lakhs, sale price is 50 lakhs. So, first rule for book value and fair value, it is gain of 6 lakhs recognized immediately. So, rule number 1 is always immediate. Okay. Recognized immediately. And the balance amount of for sale fair value of 46 lakhs and sale price of 50 lakhs. So, there is a profit of 4 lakhs. So, profit of 4 lakhs deferred and amortized. So, in scenario 3 alone, you will have one gain recognized immediately, one gain deferred and amortized. Okay. So, remember the two rules. Rule 1 is always immediate. Profit or loss or both are immediate. In rule 2, loss is immediate, profit is deferred and amortized. I hope question 12 is clear. Question number 13. A machine was given on 3 years operating lease by a dealer of the machine for equal annual lease rentals to yield 30% profit margin on cost of 2,25,000. Economic life of the machine is 5 years and output from the machine is estimated at 60,000, 75,000, 90,000, 120,000 and 105 units, 105,000 units for 5 years. Straight line depreciation is proportion to the output considered, in proportion to the output is considered appropriate. You are required to compute the following. Annual lease rent. Lease rent to be recognized for each year. Depreciation for 3 years. First question, is it an operating lease or finance lease? Question number, in the question, the first line itself says a machine was given for 3 years on operating lease. Okay. So now we know that here the books, it is going to be recorded in the books of the lessor only. Depreciation, asset, everything will be in the books of the lessor. We are first going to calculate annual lease rent. How do we calculate the lease rent? We have been given, so let's see what information is given. We have been given the total cost plus profit margin. So we know what is the total price that we have to sell. The lease period is given for 5 years. Okay. Now in operating lease, we are not worried about rate of interest. We are not worried about the rate of interest or IRR, whatever it is. We only want to know the proportionate interest, proportionate lease rental. So the calculation is going to be total lease rent, which is nothing but 130% of 2,25,000, because the cost is 2,25,000. Margin is 30% on cost. So total rent is going to be 1,30,000 into, sorry, 130% into 225,000. What is the value? 292. Okay, let me write that. 292,500. Now the proportion in which we are going to take the lease rental is going to be output for lease period. For each lease period, whatever is the output, divided by total units of output. Okay. So let's see the question. The question says the output for the lease rental is 60,000, 75, 90, 120 and 105. So what is the total estimated output? 4,50,000. Okay. However, listen carefully. The estimated economic life of the machine is 5 years, for which 5 years output is given. What was the total output that you found? 4,50,000. However, the lease rental period is only for 3 years. So what is relevant is the first 3 years output for us. Okay. What is relevant is the first 3 years output. So what is the total of the first 3 years output? 60 plus 75 plus 90. 2,25,000. So my proportion is going to be for 2,25,000 units, because I am leasing it only for that number of units, only for 3 years. So 2,92,500 into 2,25,000 units divided by 4,50,000 units. Okay, which gives us 1,46,250. 1,46,250. Okay. Now what is this 1,46,250? This is the total amount that you can recover from the lessee as rent for 3 years. Total amount recoverable as rent for 3 years. Now the question says at equal annual lease installments. So what we are going to do? 1,46,250 divided by 3. So annual lease rent will be 48,750. Take a minute to understand and note down the hints. Okay. This is answer to subdivision 1, which they are asking the annual lease rent. Second subdivision. This is where you will have to understand the difference. Lease rent income to be recognized. So for lessor, annual lease rent need not be the income to be recognized, because for lessor, income has to be recognized in proportion. Okay, how it will be recognized? Very simple. 1,46,250 in the proportion of the units. 60,000, 75,000 and 90,000 units. Though he receives the lease rental as equal installments, income will be recognized only in proportion of the units that are estimated. 60,000, 75,000, 90,000. So if you calculate the proportion into 60 by 225, 75 by 225, 90 by 225. So for year 1, the calculation is going to be, let me write the calculation. Total lease rental recoverable 1,46,250 into 60,000 divided by 2,25,000, which is 39,000. Similarly, for year 2, it is 1,46,250 into 75,000 divided by 2,25,000. 48,750. 46,250. And year 3, similar calculation. 58,500 into 90,000 divided by 225, which is 58,500. Sorry, 146,250 into 90,000 divided by 225, 58,500. So question subdivision 1 and subdivision 2 are very different. Subdivision 1, total amount divided by lease period is annual installment. Whereas if they ask you income to be recognized, it is in the proportion. Okay. Right? Moving on to subdivision 3. Depreciation for 3 years of lease. The question says depreciation is in proportion of the output. Now, what will be the depreciation? Now here again we need to remember we are in the books of lessor. For the lessor, 3 years is not the period. The period of the asset is 5 years. Hence, total output will be taken for depreciation proportion. So, depreciation will be in the proportion of 60,000 is to 75,000 is to 90,000 is to 1,20,000 is to 1,05,000. So, accordingly, calculate your depreciation. I have not given the calculation here, but you can calculate the depreciation. Okay? Total value of the asset. Will depreciation be on 2,25,000 or depreciation will be at 1,46,450? Depreciation is on the cost of the asset, which is 2,25,000, not even the profit margin. Remember, this 2,25,000, it will be taken for 5 years over the output proportion. Remember why we are taking this as 5 years? Because this is an operating lease and the asset remains in the books of lessor and not lessee. Okay? Got it? Okay? So in operating lease, remember the rule? Everything is from the lessor's perspective. Lessee ko onne onnuda. What is the lease installment? That's all. For operating lease, every calculation comes from the lessor's perspective only. Right? So this is question number 13 for you. Question number 14. Suraj Limited wishes to obtain a machine costing 30 lakhs by way of lease. Effective life of the machine is 14 years, but the company requires it only for first 3 years. It enters into an agreement with Star Limited for a lease rental of 3 lakhs, payable in arrears, and implicit rate of interest is 15%. Chief accountant of Suraj is not sure about the treatment of these lease rentals and seeks your advice. What is this lease? Is it operating or finance lease? IRR is given, therefore it is finance lease. Abdina, 200% we are wrong. We need to check the indicators. What indicator is available in the question? Out of 14 years, the asset is used only for 3 years. So the life of the lease is not covering the significant economic life of the asset. Therefore, this lease shall be treated as operating lease. Avladha answer. We need not do any calculation and show. They are only asking us the treatment about lease rental. So it shall be treated as operating lease and the installment payable. What is the installment? 3 lakhs. Correct? 3 lakh rupees payable every year shall be treated as expense in the books of Suraj Limited. Simple answer. The only hint here is checking whether it is operating or finance lease. And common mistake that we will do is interest rate. Our mind will think that it is only a finance lease, which is wrong. Okay? This was also one of your past as papers only. Okay, past as or RTP, I am not remembering right now, but one of the two. So let's see how the answers are framed. In a finance lease, the term of the lease term should be for the major part of the economic life of the asset, even if the title is not transferred. In the given case, useful life is 14 years, whereas the lease is only for 3 years. The lease is an operating lease. Lease payments under the operating lease should be recognized as an expense in profit and loss account on straight line basis over the lease term. Simple answer for us to conclude. This is question number 14. Question number 15. Jaya Limited took a machine on lease from Deluxe Limited, fair value being 11 lakh 50. Economic life of the machine as well as lease term is 4 years. So life is compensating the lease term. At the end of each year, lessee pays 3 lakh 50,000 to the lessor. Jaya Limited has guaranteed a residual value of 70,000. So guaranteed residual value is 70,000. However, Deluxe Limited estimates that residual value will only be 25,000. The implicit rate of return is 10%. Present value factors are all given. Calculate the value of machinery to be considered by Jaya Limited. So we are in the books of Jaya Limited, who has taken the machine on lease, so which is lessee's book. Is it finance lease or operating lease? Finance lease. Now, what is the rule for machinery value for finance lease? Cost of the asset is present value of minimum lease payments or fair value, whichever is lowest. Now, in this question, ஒரே ஒரு point to be remembered. We will do the calculation. I'm very sure you all will be doing the calculation. What is the guaranteed value that you will take? Is it 70,000 or 25,000? Yes. Lessor is anticipating 25,000. Even if it is less than what the lessee is guaranteed, doesn't matter. What the lessee is guaranteed, 70,000 flat, you need to take that only as guaranteed residual value. So the only hint that you have to remember in this question is, let me write the hint for you. Irrespective of what lessor anticipates, guaranteed residual value is the amount guaranteed by the lessee. Okay, this is the amount guaranteed by the lessee. Suppose 70,000 is the guaranteed residual value. 1 lakh is the anticipated residual value. What is the difference? That 30,000 will be unguaranteed for the lessor. Lessee ku kavale kadayadu. Lessee, whatever he guarantees, that only will be the amount. You don't have to complicate it at all. Whatever given in the question as lessee guarantee, you can take it directly. Okay. For lessor, lessee's value will be 70,000. Less unguaranteed, if it is there, then you can take that. Okay. Now this question, calculation, I believe you will be able to do it. So I'm not doing the calculation now. You can try it at home and check the answers with the solutions. So with this, we have covered AS 19 in its length and depth. Very, very practically tested standard, repeatedly tested standard. Okay. So areas of question, whether it is an operating or finance lease. Especially question number 14. Questions like question number 14 are where you need to be careful. Second question, under finance lease, accounting in the lessor books, lessee books. Operating lease, calculation of lease installment, lease income for lessor. And sale and lease back transactions. So all these are the patterns of questions. The 2 classroom examples plus the 4 questions that we have done in the class. So these 6 or 7 examples that you take, this will be your exhaustive patterning type in your lease AS. Okay. Take a quick break for 5 minutes and 5-10 minutes, and we will resume with the last standard for the day, segmental reporting.